Friday the 28th of July, just going into the briefing then discussing what was around the time when we left the markets yesterday, started to see a pretty big sell-off in the US equity market without really one single new fundamental catalyst. I guess obviously from a broader week perspective, we have been trading up at all-time record highs across the major three indices, and as such it appeared to be weakness in the tech sector specifically that just led to a pretty aggressive downturn over about a 90-minute period. So you can see here from my center charts, if I'm just looking at the S&P firstly, you had a fairly tight range during the European session with pivot holding much of that price movement, and then bang, it broke that level and then it continued to tumble through S1, S2 all the way down. You know, pretty sizable move in the recent context of things. And if we look at the Nasdaq, the move is probably even more violent. Again, that R2 was holding up on much of the price action, having crept up on the evening before in the Asia Pac session. But then a complete kind of breakdown from 5:30 really to 6:30, where it was a sell-off of, well, percentage-wise, the move in the Nasdaq, it went from basically a record intraday high where we were trading of around plus 5% on the session to down 1.5% in about the space of 90 minutes. Now, again, there wasn't one single headline which caused the market to just drop like that. The fact as well that it took, kind of 90 minutes of phased selling would be indicative of that. If it was one piece of actual headline news, typically the market tends to move in one straight line. The other big thing, of course, is the fact that volatility has been so minimal. Before the actual fall in the equity market, Deutsche Bank had been saying that excuse me, Deutsche Bank was saying that pre the move lower, we were on course for the 11th day in the row with the VIX below 10. This is kind of unprecedented, extreme low levels of volatility. What happens then when you start to break out of that regular kind of mold? Then the market all of a sudden, has a big shakeout because it's not used to now this type of price movement. One thing, one valid point is that a sell-off of the gravity of what we saw yesterday, if this was a couple of years ago, we wouldn't have even blinked an eye, because this would have been just absolutely normal price type of movement on a typical day, a move of about 2–2.5%. The difference being in this current economic environment is we're only used to very minimal percentage swings at one point at a time. There were a few people pointing to, there was a broker note suggesting the end of low vol environment was nigh. But again, this was all kind of, I guess, people backward looking to pin a piece of news to a move, which is often the case. But yeah, quite a big sell-off. But when you're up at these record levels, I don't think it's hugely unsurprising. Personally, I did find the market's interpretation in the wake of the FOMC meeting quite overtly dovish. I know the market focused on the aspect that they downgraded slightly the language around inflation, but they did also upgrade the fact of the tightening of the balance sheet language. So tightening is definitely on the cards and on the agenda for the Fed, which would prove to be ultimately a net negative for equities. So maybe a little bit of aftermath and second thoughts on that. But what tends to happen, because I was still here when that was selling off and I was talking to a few of the guys, is you tend to see the market drop and then technical levels break, momentum kicks in, algos then jump on that momentum, it moves lower again, other corresponding US indices then break their respective key levels of technical support, and then the market legs lower and lower and lower. And so it almost self-capitulates in a way in that regard. Dara mentioning München and Paul Ryan comments regarding the sell-off, talking about currency manipulation and no border tax. So there's a couple of different things that people will obviously circulate, but the net result was that once it started moving, obviously everyone started to then jump on the trend and kind of break from that low volatility normality, just causing everyone to kind of jump on the move and take advantage of that. But looking at the tech space in particular, because the Nasdaq, as we can see here, did kind of initiate the move and was the kind of bigger underperformer. Aftermarket, you did have Amazon reporting, and they had a 7-quarter low for their profits at Amazon. So, you know, when you're talking about these extremely large cap companies, maybe there was a bit of nerves going into that release as well. But looking at other headlines, this is one of the other ones that has come out, and this is on a similar kind of US political theme. And this is looking at the fact that last night we had yet another try at repealing Obamacare. They were calling it the skinny repeal. That's what it was being deemed as. So, the problem being, Republican Senator John McCain joined 2 of his GOP colleagues to block a stripped-down Obamacare repeal bill early Friday. So once again, this months and months of effort to pass this health legislation continues to fail and stumble at the final hurdle. So it's probably not as well helping sentiment overall, but I think this came after obviously the move, and I think this is more people coming a little bit accustomed to this delay on specifically the healthcare bill. So I don't think it's going to be a massive thing, but obviously, you know, the question marks is, will this ever get done? But one would think there that the concessions are getting to a point where the vote is getting closer and closer and closer to a point where you would imagine it would pass eventually. On the British front, Brexit talk has become, I guess, maybe a little bit quiet. Having a quick look here what Chancellor Philip Hammond has said. And, you know, just because I'm an analyst, it's not the reason why I'm saying this, but the guy who does the economics making the most sense when it comes to British politics, Philip Hammond has told business leaders he wants to negotiate a simple off-the-shelf transitional deal with Brussels to maintain current trading relations with Europe for at least 2 years after Brexit. He wants a standstill transition, leaving companies with full access to the single market and customs union, followed by a further implementation phase while a new UK-specific trade accord is put in place. So again, Hammond's objective here is to mitigate any potential uncertainty and slowdown in the economy about trying to negotiate a new deal now. What's most important is we must secure this transitional deal, because there's no point trying to negotiate with Europe. The stronger hand is on their side. You know, if I was Europe and Theresa May tries to push hard Brexit and so on and so forth, or tries to really hard negotiate this divorce bill, all I'd do as Europe is just cross my arms, sit there and say, fine, let's wait it out. You're the one who's going to feel the real pain when Article 50 expires in March of 2019. So this is the most logical argument. This is the one we've been talking about for a long time, and I think Philip Hammond's just calling it out for what I feel will eventually be the case. And obviously a transitional deal would at least provide a degree of clarity. And this is what banks like Morgan Stanley, who are bucking the trend of what the general consensus is on Wall Street, which is that for the next 6 months of this year, the pound generally against the dollar will depreciate. MS are actually going for a counter trade to that. They're actually saying if we can secure this transitional deal, then actually that provides enough clarity over the coming years to return of some confidence, and the pound should actually rally against the dollar. Particularly as well, given the more weaker state the dollar has been in, specifically in the last couple of weeks, under political uncertainty, Fed's ability to be able to remain hawkish and becoming more dovish as we saw midweek, and so on and so forth. So I think this is, you know, another reason why possibly the pound is still up here at 131. We've not really seen a dramatic sell-off. Granted, as I mentioned, the dollar though has probably been a big contributor in the last week or two, the dollar being weaker overall. In terms of actual commentary, the EU Brexit negotiator Barnier told EU ambassadors that he does not expect enough progress will be made by October to allow the start for talks on a future relationship with the UK. Conversely then, what does David Davis says? He says, we will make enough progress by October. So again, not a great deal of movement on the official talks at the table in Brussels, but certainly the Chancellor is trying to push on for this transitional deal, which I think is ultimately very key in the short term for the direction of sterling currency. The longer this part takes, the more negative a force that will become for the pound, I feel. Just having a quick look at the pound this morning. The dollar is a touch weaker, so euro dollar seen up marginally. We had a brief attempt at trying to get above pivot, but it's pulled back below there for the moment. But if we're looking at cable, we're kind of sitting just sub the 130 handle. Pivot providing close to some of the highest points of the trade seen in the overnight Asia session. Pivot residing at 131.15 today. That previous high back on the 25th, beginning of the week, also just providing a bit of a point of resistance as well around this 131.07. Downside though, yesterday afternoon's low, so 130.73, and then beyond there you'd be going back to the 26th with that low at 130.21. So kind of price points doesn't look particularly interesting where it is right now, but certainly if it starts to move towards some of those levels, it could be something to just keep an eye on with the sterling currency. Okay, sticking with the UK, finally, one last piece of news to be aware of. I don't think this is going to surprise anyone. Consumer confidence, as measured by GfK survey released overnight. British consumer confidence has now fallen to levels of Brexit poll aftermath. So the GfK survey, which is used by the European Commission's EU-wide monthly economic sentiment index, has fallen to -10 in June, or from -10 in June to -12 in July. It's the same figure that was recorded back in the immediate aftermath of the EU referendum last summer, which dates back to when the survey began many years ago. Looking at where we are here on the actual confidence score index, you can see here we've dropped beneath that low point that came in the summer of 2016. So again, this feeds through into the fact that next week, of course, we have the Bank of England interest rate decision. It's the month of August. We'll get the quarterly inflation report. It's kind of the typically when we see the update for the forecast on inflation and GDP. And so it gives us a bit of an insight as towards what is the feelings with the MPC about the future direction of monetary policy in the UK. Now, everyone was looking to this meeting as being potentially interesting just a few weeks ago, because in June, you remember, we had a 5-3 most hawkish leaning 3 being to vote to immediately hike rates in the UK. It's the most hawkish split that we've had in about 10 years. That was the last time when we had an interest rate hike, basically, in the UK. The composition of that MPC has changed. Christine Forbes, as you know, the most hawkish member of the BOE, has now left, has now been replaced by a chap yesterday. I'm just trying to recall his name now. If I just go on the Bank of England website, let's just get that up, because he has now been appointed the new, well, this is the guy here, Sir Dave Ramsden is the new Deputy Bank of England Governor. This chap here in the centre image. Now, obviously, a lot of people don't really know what Ramsden's view is on monetary policy as yet. A few people are looking back to previous statements that he gave, but they're pretty dated. I read one yesterday that was about 5 years ago. So usually when a new policy member comes in, especially if they're a deputy position, so most closely aligned with the governor, they tend to be sitting a little bit more neutral. And what I'd suggest you're likely to see then is the balance is going to go back to possibly a 6-2 vote split when we have that Bank of England rate decision. So Ian McCafferty, Michael Saunders, at the sake of losing credibility, I think will probably remain their call for hiking rates. And again, the reason why their argument has diminished is because inflation in the UK dropped from 2.9% to 2.6%. That's what we saw last week.
expectations obviously were for it to remain up at around that 3% threshold. So a surprising decrease in inflation will probably lessen the argument for immediate action, but for the sake of just losing face, McCafferty, I feel, and Saunders will continue to back a hike call. If inflation, the next reading, then becomes low again, they'll probably revert back then to the main group, because the bigger argument of the majority is that irrespective of this high point of inflation, as we know, anemic wage growth, as we've just seen, consumer confidence is at the worst it's been since the shock of the EU referendum, and saving rates are at record low. Economic data in the UK would suggest that we're going through a period of a slowdown. Extrapolate that with the political uncertainty in the period ahead, and that gives a pretty overwhelming argument to suggest that we should not be hiking interest rates in the UK. That being said, then next week I would not be expecting any fireworks to come out of the Bank of England meeting. What could have been interesting if inflation continued to run to the upside would have been many of the MPC members would have thought we're left with no other choice but to hike rates, irrespective of those weaker conditions elsewhere in the economy. But now that's fallen away, probably that meeting's grown less in importance going forward. Okay, earnings season in Europe is fully up and running, even though it's a Friday. You've had a number of big banks report. Rather than go into them specifically in detail, I'm just going to quickly run over some of the main headlines that have come out. So, in the FTSE, Barclays posts a loss on PPI charge, efforts to simplify the lender. The lender posted a net loss driven by efforts to sell down its African unit and an unexpected charge for PPI scandal. I can't believe these UK banks are still paying for PPI. It's unbelievable. It seems to be several years now that they're still paying for this PPI scandal that's been going on for such a long period of time. But that's Barclays. Credit Suisse earnings beat expectations. So Credit Suisse enjoyed the better than expected earnings across almost all of its key divisions in the second quarter of the year. UBS gets a boost from Fed rates as client activity surges. The bank beats estimates with quarterly profit up 13.5%. BNP Paribas, so for Philippe in France, BNP Paribas reported a drop in second quarter net income on Friday, but beat analyst expectations as the group's cost-cutting and healthy investment banking performance continue to bear fruit. And then moving over to some of the other sectors that we've had, IAG in the FTSE, shrugging off power failure to sort a double-digit profit rise, as low fuel costs and a strong Easter has helped the airline company. In the car-making sector, Renault, they reported an 18% increase in first half profit. Their operating profit rose to 1.82 billion euros. Now, that sounds pretty good. The only problem is with Renault, analysts were expecting 1.85 billion. So Renault shares, when I last looked, were down about 5%. So again, this is when you've got to be a little bit careful with just going off a headline, because you would read that. This is when I think journalists at Bloomberg do a really bad job. This is when they say Renault first half profit climbs 18%. You would think, wow, that's really good. Surely the shares would go up, and then they open down 5%. Because what they're not suggesting here is that the market was expecting that, and actually we were expecting more, and they failed to live up to that. And their shares have fallen quite sharply. So again, always be a little bit careful with the underlying information. And then Adidas, another notable name in Germany, they've lifted their outlook. Now, lifting outlook is nearly always translates into a positive reaction when the stock gets underway. I was just listening to some of the commentators this morning. Retro wear coming back into fashion, helping the likes of Adidas lift their sales outlook going forward. Okay, quick look at what's coming out this morning. We have already had a couple of the German state CPIs. I think they've started to come out. As you can see here, you've got Saxony, Brandenburg, Bavaria coming out, Hesse through the morning. Just trying to see, Saxony came out, what the numbers were year on year, 1.7. That's unchanged against what it was last month. The month-on-month 0.3 from 0.2. So probably that might explain that little flutter that you had in the euro currency. Maybe a quick reaction to the Saxony number coming in. The month was a slight uptick on the previous month, but the year-on-year net was unchanged. So a pretty constant inflationary conditions there. What tends to happen with these German state CPIs is they tend to be fairly complementary of one another, i.e. all come out fairly similar. And so actually this pan-German CPI number, really there's no need to highlight that data because it's irrelevant, because at that point we've already seen all the German states report. This is just the actual calculation of the national number in Germany. So this 1 o'clock figure never moves the market. If it was going to move, then it would move on these earlier releases of the individual regions. But as we've seen with Saxony, not too much difference from the previous month. Going through into the rest of the session, apart from those, you have a cluster of the sentiment and climate data out of the Eurozone. Now, I know this sounds quite interesting when you hear words like economic sentiment, industrial sentiment, service sentiment, but historically, very rarely does this have an ability to move European assets, so it's something I'd listen out for, but I wouldn't really be prepping up for a trade on the back of. And then we go into the US session, and then things start to get a little bit more interesting. We've got the second quarter reading of US GDP. We're also looking at employment wage data, and then you've got the final reading for July of University of Michigan sentiment with Baker Hughes rig count. And that's been quite interesting because we saw last Friday a bit of a plateau where rig counts were subtracted by 1. And this is interesting because we've been on a pretty consistent move higher in crude oil. And if rigs, in rigs coming back online, if that starts to dissipate, then obviously you'd be expecting US output to also start to plateau. Just looking at oil this morning, pretty flat. Looks like we found a bit of a floor from pivot earlier this morning, but it's a pretty decent trend that we've been on here in recent sessions. You know, really ever the pickup since the 24th. So you're going back to really the weekly performance. I mean, this is some pretty decent moves we've been seeing in crude over the course of week to week at the moment. I mean, going from the low to the high, talking about nearly an 8.5% rally that we've had. Obviously the big target on the upside, now that we've managed to get above and find well, pivot at the moment, but also we're sitting at pretty much the 49 handle, then 50 is the next kind of big psychological level. If we were to get back up to there, that would be probably quite significant. Just having a look slightly longer dated where we are in the grander scheme of things. And you push beyond there, then we're kind of back to that consolidation phase really that we're in over the first few months of the year. If I just tidy this up a little bit. Going into the beginning of this year, so what I'm talking about really is kind of that low that we were printing back in March to the 55 high. So it's really this phase of price action that we were looking at through the beginning part of the year. It was locked in that kind of space there. The range was kind of 47 to 55. Then we kind of had this new block of activity from around 42 to 47. Now that we're back above there, it's going to be interesting to see whether if we can reclaim 50, I guess the next logical target is going to be that high that we had back in the end of May, that coming in at 52. And then above there, obviously, we go back to the highs that we're seeing going year to date and towards the end of last year. You would think, though, that it would start to struggle possibly getting up to the higher end of that, with US output still, for the time being at least, tracking higher. But we shall see. OPEC officials can sleep soundly for the time being, let's say. Okay, coming up to 9 o'clock then. Going to leave it at that. That's your briefing for this morning. Any questions, of course, just let me know in the chat room. Happy to help. I will be here for the morning, and then I'm going to be lecturing this afternoon, so I'll be swapping with Sam, and he'll be covering for me this afternoon on the mic. Okay, guys? Have a good session, and if I don't speak to you before then, have a great weekend.